All right, so we're talking about a handful of different articles today, but they all kind of point to the same thing, which is that multifamily is kind of in distress. There's a lot of numbers being thrown around. So let's talk about this first article, which is commercial mortgage-backed securities, or CMBS, delinquencies hit a record high. And I see a number on here that's 11.8%. Just kind of break that down. What does that mean? It
Yeah.
even says on here that it's these numbers have surpassed the Great Recession. That's a big deal.
Yeah, the Great Recession was mainly caused by mortgage-backed securities of individual homes.
Mm-hmm.
CMBS is commercial mortgage-backed securities. So
Okay.
this is for the commercial real estate that is the underlying asset. And the article is pretty striking because it's pointing to the fact that commercial real estate is having its highest distress since the Great Recession in 2007, 2008.
Yeah.
That was mostly single-family homes. There was some distress in commercial at the time, but we are in one of the more difficult times for commercial real estate, and that includes apartment buildings, it includes offices, it includes industrial, it includes hospitality, is all kind of into that commercial arm. And we've been talking about this for a few years. We knew that as interest rates ran up, that operators would have a hard time meeting the debt obligations because a lot of those operators bought those buildings at prices that were pretty high and assumed lower interest rates. And you have to remember that real estate's largest cost is its interest cost, its debt cost in most cases. So when your debt cost increases by 5% on a $50 million loan or a $100 million loan or even a $10 million loan, it's a dramatic increase in your costs. And we started seeing it a few years ago, and we're continuing to see it now, is that folks, operators, developers who got into these deals at lower interest rates, now that interest rates have reset, they're not able to pay those back on the timetable.
And is this why, we talked about this a couple of weeks ago, is this why we're seeing a lot more foreclosures and things like this as well?
Yeah, we're starting to see foreclosures at the commercial real estate level. Kind of pre-foreclosure, you also see different workouts where operators will try to work things out with lenders. They'll try to write down the debt. They'll try to do a principal buy down, principal reduction. That was really what was happening in 2024. There was a lot of those negotiations happening. There were some foreclosures in 2024, but it was a lot of extend and pretend. Let's give this a little bit more time, see if we can get it worked out. And now what we're seeing in 2025, there's much more of the banks and the lenders saying, no, it's time for us to figure this out. And if you can't figure it out, we're going to have to foreclose and move on with the next step. A lot of it does depend on if it's a traditional bank is the lender or if it's a private money lender. They have very different requirements when it comes to foreclosing, when it comes to the accounting process. If they do foreclose, a bank, for example, if they do take a property back, they have to, in a short period of time, write that into their books that they've taken a loss on that loan. Private lenders have more flexibility. They may take a property back and operate it for a few years and see if the market comes back and to see if they can get their full principal back, balance back. So each situation is very different, but I can tell you we're seeing more distress than we've seen since the Great Financial Crisis. We see it as an opportunity. You can make more money in a down market if, as an investor, if you're willing to dig in, understand what's happening, because that's when you can get the good deals. You buy low. In real estate, you make your money at the purchase. So if you can buy stuff at a low price, operate it, run it well, hold it, and then sell it at a better time, you're going to do really well from an investment standpoint.
So even though this seems like it's a very scary thing, this is actually a time of opportunity for people out there who are smart and have put themselves in a position to buy right now.
I knew a guy who was a wealthy individual in the 2007, 2008 financial crisis who bought 50 homes in exterior parts of the Phoenix area.
Mm-hmm.
And he was buying these homes that were selling for $400,000 and $500,000 for $120,000. But he had the foresight to know that market's going to come back.
Mm-hmm.
And he had the financial ability to go buy these.
Yep.
And he made a killing because in 5-6 years, those properties came back. He bought them at a really low entry point. And I learned a lot from that because I learned when times aren't looking good, that's the time to actually be aggressive
Mm-hmm.
about buying. When everyone's talking about how great real estate is and how all the the values have gone up and all this money's been made in real estate, you've missed the boat by several years because the folks who bought those buildings at the low part of the cycle are the ones who are making money, not when you're buying it at the peak. So I've learned from that, and you do have to navigate and be careful in those decisions that you make, but I like it when there's downturns. I like it when there's pullbacks. It's an opportunity for you to go in and take advantage of whatever the situation is at the moment.
And that's what you guys are doing, which is really cool and really exciting here at Neighborhood Ventures. Let's get into the second article, which is Trump's sweeping new law. This talks a lot about the opportunity zones. Can you talk a little bit about what the opportunity zones are, and do you think this will lead to smarter investments, or do you think this will lead to less participation?
Yeah, in general, most folks in the commercial real estate investment space are seeing this new bill as slightly positive. Not much negative came about. There were talks that some of the important things that facilitate the commercial real estate market might be changing, whether that be changing the 1031 laws.
Mm-hmm.
Changing carried interest, and most of those things in the bill have not changed. They did reinforce opportunity zones, and opportunity zones are a way for folks who have a very long-term hold period in mind where they can put cash into an opportunity zone fund or investment, and they have some really attractive tax incentives, but you have to be very long-term minded, like 10 years out.
Okay.
And Trump in the first administration introduced those, and then in this follow-up his new administration, and as part of this bill, they're reinforcing those again.
The theme that I'm getting is a lot of what you're saying is for people out there who are investors. Think about this in the long term. Don't panic. Don't freak out about what's going on right now just because you see things dropping, just because we see, things changing. Maybe it seems like in the negative. This is an opportunity. This is a time to invest if you have the means by which to do so. What are some other, impacts or things that are going to change from this bill that was just put into place?
Yeah. So this big, beautiful bill, as it's been called. So a couple things that came out about on this bill. 100% bonus depreciation is reinstated. I won't get in the weeds on that, except to say that bonus depreciation is really important for real estate. It's also important for manufacturing companies and tech companies as they invest in R&D. But being able to accelerate the depreciation on an investment has an incentive for businesses and real estate owners to spend more on capital expenditures. That's the important part. So it's going to continue to incentivize folks to do that. That was due to come up in expire if it wasn't renewed, and that was reinstated. The other part that is important for higher net worth folks is what they call SALT, which gives people who live in high tax states New York, California, a deduction on their federal income taxes if they're paying a lot of state income taxes. That was $10,000. Now it's $40,000. That matters more to the higher end people than and a lot of higher end people invest in real estate, so it's that's seen as a positive. The 1031 laws where you can exchange, no changes there. Those continue. No changes into REITs or being able to do some of these tax deferral strategies like an UPREIT. So overall, I think the bill is a net positive for real estate and for real estate investors. And that's kind of what you can expect from a president who was a real estate investor himself.
Right.
And that's what we got with this bill. Now, we're not going to get into anything else with the bill. Our deficit is going to continue to grow. There's at some point we're going to need to tackle that because we're 35 trillion or so in debt as a country. So at some point we need to start taking it the other way. This bill does not do anything with that. So as a citizen and as a financial person, that's something I'm always concerned with.
Right.
That wasn't we didn't do anything with that.
This bill is not for that. Yeah.
This bill is not for that, and that's part of why some of these folks who were really supportive of the president, mostly, notably Elon Musk, has now withdrawn his support from the president, wants to start his own party because he wants to tackle that. So it didn't solve everything, but from a real estate standpoint and from a standpoint of what needed to go in this bill, what are some key things that needed to be addressed, there were many things that were addressed in it.
Yeah, it's pretty sweeping. There's a lot of stuff that we're not even touching that in terms of like underserved communities and things like that, but we don't have to get into all that.
Yep.
So this next article, Multifamily Market Under Pressure, this is basically just a synopsis of everything we've been talking about. Talk a little bit about what the sharp year-over-year price drop in multifamily properties signals just about the broader real estate market. I mean, you kind of already talked about this a little bit, but this also goes back to my question about, do you have any advice for people who are investors and they're seeing all of this happen and maybe they are panicking? What would you say?
Yeah, the advice is be patient, see it through the cycle. Right now is not a good time to sell commercial real estate. And in our case, apartments. It's not a good time to sell apartments. Not because the fundamentals of apartments is bad. In fact, our apartments are full. Our rents are strong. People are paying the rent. But we have seen a lot of new supply of apartments, and that has depressed any rent growth. When interest rates were low, a lot of developers said, let's go build at low interest rates. And that building has put a lot of new supply in the market. Now, that new building is going away because interest rates have been high for a while. So the plans have all been scratched. And that's why we're in a cyclical industry.
Yeah.
But right now, the industry is all kind of absorbing this, taking it in. And the fundamentals with multifamily remain strong because it still costs twice as much, 50% more, to own than to rent nationwide.
Yeah.
So more people are renting for longer. More people are deciding in their mind, I don't really need to own a home. I'll do other things with my investments. And that's why we have a very constructive, positive view going forward with multifamily, if you can be patient in the downturn that we're in right now. Because the properties are still generating income. They're still doing well. We just need to get through this blip. And if you don't need to sell right now, the property is doing fine. And when all this new construction is completed, we're going to have a period of 4 or 5 years where rents are going to be moving up pretty dramatically because there's not going to be enough new construction to support supply in growth areas like Arizona and the Sun Belt. So you got to get through these periods. Don't panic. You have to have that old adage from Warren Buffett, where when everyone's panicking is the time to be greedy, and when everyone's greedy, it's the time to worry. So right now, it's the time to be patient if you own real estate. If you don't own it, now's a great time to invest. I'm talking to several folks who have cash from sales of businesses or other significant cash sitting around, and I'm advising them you should buy an apartment building, or you should invest with us significantly in one of our apartment buildings because you can get in at a really good time. It's also really important if you own an apartment building right now to really focus on the operations, the property management, the maintenance. Keep your people that are living at your property happy, and they're not moving.
Yeah.
They do not want to leave. Our lease renewals are as strong as they've ever been. Because people are not going and buying homes. They're happy to stay where they're at if they're getting good service and if they like where they live. So the focus for apartment owners is to get through the period, focus on operations. It's a good time to, what Steve and our Covey used to talk about, sharpen the saw, make things a little better with how things are being done right now. And that's what the good operators do in times of downturn. And then when things get good, you have a property that's really positioned well to sell it, to refinance it, to do things with. And that's what we should be doing right now.
No, I think that's really good. Okay, so then let's get into this monthly sales review, and let's kind of talk about some comps and where everything's sitting right now.
Yeah, so we focus on the Phoenix metro area. The Phoenix area in June had a total of 7 sales with apartments of 100 units or more, and 7 sales with units from 10 to 99 units. So 14 total transactions in the Phoenix MSA.
What is it normally?
That is probably 20% of what it was in the busy times. We're trying to find what the new normal might be. It's still very low. When you talk to brokers and folks in the industry, I think they'd like to see 2 or 3 times that on a regular basis. But the number does move around a lot because when things get hot, a lot of buyers pile in, and there might be 30, 40, 50 transactions in a period. And the big one to look at is the 7 cells with 100 units plus. And I think the positive side is transactions are still happening here.
Yeah.
And the average price per unit of these larger apartment buildings, $262,000 a unit. I'll just point out a couple of the bigger transactions. The 2 at the top, one in Scottsdale, which is a highly desirable area, 90s built property, 400 units, and it traded for $288,000 a unit. The one just under it, 2013 build in Gilbert, $310 a unit. Little bigger units there, but those are big, $100 million plus acquisitions. And then the third one is also in Tempe, about $100 million, and it traded for $269. These are large institutions that are buying in Phoenix, large banks, large pension funds. They're not buying properties that are distressed. These properties are stabilized. They're generating cash flow. They're getting a decent deal on them relative to where we were a few years ago. But even though there is some distress going on, and the buildings we're buying right now are all distressed, we're buying them from distressed sellers. So we're getting really good deals on them. People are still buying. Smart people with deep pockets are still buying property in Phoenix, multifamily, and these are not distressed. So it's good to know that the market is still happening for in our market. People are still investing significant dollars here because they believe in the long term. They know that renting is much more affordable than buying right now. And they expect rents are going to be going up over the next few years because our supply demand scenario changes. So we're going to continue to track these on an ongoing basis and see what happens with where the market's at. But there's some good and some positive things, and then I think some opportunities too in what we're seeing today.
Yeah. No, it's really cool. It's really exciting too to know that even though we're in a downturn of the cycle, Neighborhood Ventures is forging ahead and buying and doing a lot of good stuff.